Good morning, everybody. Happy Thursday. It's October 5th, 2023. Great to be with all of you today. My name is Bob Lang and with explosiveoptions.net. Time for our daily bites. If you're new to the show, welcome aboard. Great to have you here and listening. We use this time on Mondays and Thursdays about 8:30 Eastern time to talk a little bit about markets, the economy, things that have happened more recently, the last couple of days in the markets, things that we can look forward to today and in the next couple of days. So we'll meet again, of course, next Monday as the next week starts off a big earnings season for third quarter. And I'm kind of excited to watch and see what happens during that time. But let's talk about these last couple of days here. Of course, Tuesday the markets got absolutely just got pounded. Yesterday, a little bit of a respite. Markets came back a bit, cut about half that loss. But today, as you can see, the futures are down sharply after release of some economic data. I'll get to that in just a minute. Down 17 handles. NASDAQ down about 55. And the Dow, of course, down 121 handles over here. So we see volatility starting to rise here. And we do see that the term structure of volatility is inverted now. How do we know that? Well, the VIX cash is at 1883. That's higher than the VIX future, which expires in October, so in a couple more weeks. So we do see an inversion over there, and that generally is negative for stocks, negative for equities. Also, another negative for equities is bond prices are down, and we see yields are up. The 30-year Treasury, which closed yesterday at 4.877, is now above 4.9. The 10-year, which we also follow as well too, TNX is the symbol for that one, and that is closed yesterday at 475. We're at 477, 4735. We're at 4767 here. And also another one we've got to take a look at is a little bit shorter term than that is the 5-year. FVX is the symbol on that one, and that is coming in at about 4.74. So yields across the board are up. Bonds are down. And what have we been seeing lately? Certainly when bond yields are on the rise, it's been a negative for stocks, right? Not just the NASDAQ, but all stocks in general, right? So people are looking at the longer term yields as a little bit more attractive. I think they saw that yesterday. I mentioned it in the chat room that overnight, Tuesday night into Wednesday, we did see a big spike in the 10-year yield, and with a drop as well too in the ES futures at the same time. So we saw that rise up on the 10-year up to near 4.9%, and then the sellers of yield or the buyers of bonds came in and started to pick at that. They think that maybe that was the limit where we're going to go. And coincidentally, as well too, ES futures tagged the 200-day moving average at about 42.35 or so on the futures. The problem there being, as I mentioned yesterday, is the S&P cash was not open at the time. So we didn't get that tag of the 200-day moving average yesterday. We would have need to get down to about 4,200 flat on the S&P 500 to get a test of that 200-day moving average. Certainly could still happen. Maybe today, maybe tomorrow, or maybe even sometime next week. We did close yesterday on the S&P 500 at 4263, so it would only take about 1.5%, a similar move down that we had on Tuesday to tag that 200-day moving average. So it seems like this morning is setting up as a risk-off day. If you have some puts, great. If you're lacking on some puts, maybe you want to buy some more puts here. Certainly, if volatility starts to climb later on in the day, we're going to see the market selling off here. Now, what do I mean by that? So let's take a look at the VIX futures over here. You can see that we had a slow drip down from about 5 o'clock this morning on volatility, and we saw the commensurate rise of the ES futures as well too. But since 8 o'clock this morning, when we bottomed out at about 1830, which was the nearly the low overnight, we've had a sharp rise up here in volatility. People are buying volatility, buying protection. And why is that? Because they're worried that tomorrow's jobs report is going to be too strong. And if it's too strong, it means that the Fed is probably going to keep their foot down on the pedal of hawkish Fed policy, which means maybe another rate hike or 2 or 3 coming in. I'm in the camp that it's very, very possible strong possibility of at least 3 more rate hikes coming in, up to 6%. We're at 5.25 to 5.5 right now. I think the next rate hike is going to come in the beginning of November. I think the deal that the Congress did to keep the government from shutting down kind of gave them cover to go ahead and raise interest rates one more time. Of course, we do have a lot of data coming out. We do tomorrow's jobs report. We have some wages we have to pay attention to. That's always been the sticking point here for me for the past 4 or 5 months. Wages continue to climb, and they're putting a lot of pressure on companies to raise prices as well too, which is just fuels higher inflation in the economy. So we have that to deal with. We also have CPI and PPI coming out next week. PPI is first. I think that's coming out on Wednesday. The Consumer Price Index is coming out on Thursday. We have quite a bit of data in front of those two numbers as well too, Monday and Tuesday. So we'll be paying attention to that because the Fed is watching this as well too. We do have meeting minutes, I believe, coming out in a week as well too. Banks start reporting their earnings next week, and I can't imagine that they're going to have too much good to say. But then again, we have seen the banks coming back quite a bit, pulling back down. So perhaps the bar is lowered for earnings and on the financials low enough that all they have to do is step over the bar to make their numbers. We'll have to see what happens next week. So let's take a look at a couple of charts here. First, let me get rid of this, and we also have the VIX here. I'm going to take a look at the VIX first, and you know we have an established uptrend here, right? Can't argue with that, can you? Even though the markets were up yesterday and the VIX came down sharply, it's up a little bit this morning. And if it continues to rise today and we get above that 21 level, I did say last week in the chat room, I said, and even put it out on Twitter, I said if we get a close above 18% last week, and we did, we're going to get or 2 weeks ago, we're going to get a fast move up towards 22. We didn't get to 22 yesterday, but we did get to 21. I still do think that that's in the cards here. But look, we are in an uptrend in volatility here, and that's something that you have to be aware of, right? The uptrend in volatility means that people are buying protection. We've been seeing it with the strong readings in put-call ratio. People are buying puts. Let's take a look at yesterday. Yesterday, even though the markets were up, we did have a high reading in the put-call ratio. We've seen that a lot on Wednesdays. My good friend Tom McClellan has mentioned that as going back to last year with the proliferation of the 0-day to expiration crowd. We've been seeing a lot of high put-call ratios coming in on Wednesdays. Wednesday, I don't know why the reason for that Wednesdays, but that it is what it is. We on the internals here from yesterday, you can see that the VOLD was actually fairly good, but not great. Not as good as the down sessions on Monday and Tuesday. We didn't really recover all that much. We did see volatility spike up here, come back down, and then we did see the trend spike up here and come back down as well too. So there's a little bit of balance between the up-down volume versus the up-down issues. And then you can see the really good concentration of green ticks all day long yesterday, but did have some red ticks early as well too. So markets just floated up yesterday, and we'll see what happens today. I wanted to take a look at a couple more charts with you. SPX, of course, again, this is a chart that shows you that we did not tag that 200-day moving average the other day. 200-day moving average coming in here at about 42.04. I want to also show you the monthly chart of the S&P, and you can see here a very, very close move on the MACD. We're at 121. The black line still above the red line, which is 113. And of course, if we get a crossover here, that's going to end your bull market, right? So I'm not rooting for it. I'm not just identifying it. Okay. So if we get crossed back over, then it means we have to cross back up for another couple more bars, couple more months to resume that bull market condition. It's just a condition, folks. It's not. It's a signal that tells you it's a little bit safer to be in the market. So of course, this last month hasn't been very safe, has it? So September and the early part of October. So far we've had 3 full trading days in October, 2 fairly bad days. Monday was actually an up day, but the internals were horrendous. Tuesday was a horrible day for the bulls. Yesterday, a bit of a pullback, but of course we are see where we're sitting at for the month here. S&P 500 again modestly up on Monday, down here. So we're down for the month so far. We closed the S&P 500 on Friday at 42.88. We're at 42.63 right now. It's down about 0.5% right now. So we'll see what happens later on in the day. I do think that we have some lower levels to test. We do have some open gaps as well too. We have open gap right here. This is one that I've been looking at very, very closely. If we do break the 200-day moving average, this one is live right here, and that is 41.15. Okay, 41.15. We have another gap down over here at about 40.61 that needs to close as well too. So that would set up basically a test from the spring where we match the roughly match 41.40 to 41.55. We're basically match those lows, and then that's where we took off from. We took off more than 10% to the upside from those levels. Don't forget, we started the year at 3,800 on the S&P 500. We're up about 10%, almost 11% on the year so far. Bonds are down sharply. Yields are up strongly. So that's just the condition that we're in right now. And I think when we think about what's happening in the markets and into the end of the year, people are going to start seeing their accounts starting to come back a little bit, and they know that if they have some gains from the beginning of the year, they've been in names like Nvidia or Apple or even Amazon or Google or some of these other names that have performed extremely well in 2023. They're starting to get a little bit of a pullback in these names, and if those names do pull back, you're going to start seeing people say, "Look, I'm going to take my money off the table. I'm not going to wait around to see if the markets do come down or if the Fed policy isn't going to change. It's going to stay hawkish or whatever." All right, it's going to feed into a little bit more selling into the end of the year, and it could be a tough road for the bulls. But for now, let's see what happens. Oftentimes we do see some bearish activity in October. October's always been a month where we've had crashes. We look back historically, 1987. 1929, we had markets kind of sort of crashed in 2008 as well too, starting in September into the end of the year. So we do have some precedent to some history there. So it's also been a month where we've seen what's called a bear killer. So the markets come down and come out of a low, and the bear market has been over. So we don't have that condition yet right now. So we'll see what happens to the end of the month. But I do think that you have to be cautious here. You have to have some protection on. I'm going to show you one more chart. One I've showed you quite a bit here, and I've been showing this to you since August, right? I've been showing you this is the new highs and lows on the NASDAQ. We've been basically negative for about two and a half months, right? So people are using rallies to sell, and they're paying attention to what's happening with the overall market. You have that Magnificent Seven: the Tesla, the Nvidia, Microsoft, Apple, Amazon, Google, whatever. I mean, all these stocks, yeah, they're real strong this year. But is it showing overall strength for the rest of the market? No, it's not, right? They're not representative of what's happening underneath the hood with the rest of the market. The rest of the market is weak, right? And if the rest of the market is weak, it's going to act as a weight and pull everything down with it. And if you're not paying attention, this is one of the best leading indicators I've ever found to work with the markets. Okay, it's a great leading indicator, which means that if you're not paying attention to what's going on here, you're going to lose out when you get over here. Okay. Hopefully that makes sense. I think it's going to be it, everyone. I wish you guys all a great weekend. Good trading today. Be careful. Keep your puts on. It's always good to have some puts on. It's nothing wrong with that. And if you're wrong, you just lift it up and move on. But I think having some good protection on here right now is practical. It's useful. It's tactical. And until we get to a little bit more clarity, probably going to get a little bit more clarity tomorrow after the earnings, after the jobs report comes out. I think wages are going to be hot. We've got to be careful with that number tomorrow, and it could feed into some more selling. So pay attention to volatility, pay attention to the price action, have some puts on. Just if you're doing some day trading, great. It's not my preferred style of trading. So I mostly stay out when it comes to that. But if you're taking some trades, make sure you book some profits. If you're up, say 20, 30%, 40% on an option, great. Take it off the table. Move on to the next one. Right? We're not here to watch our trades go up and then go right back down again. You know, we're not spinning our wheels over here. So take what the market will give you and move forward. So have a great day, everyone. Have a great weekend, and I'll see you guys all back on Monday. Take care. Bye.
You know that it would be untrue. You know that I would be a liar if I was to say it